This meeting is being recorded.
Well, there we go. Happy week 152. Last week I said week 158. I don't know what in the world I was thinking on, but it's 152. And by the way, for anybody joining here, this is a screenshot of our first webinar. I'm not looking too good. Adam, we've changed, we've dumbed down the dress code quite a bit. So that was March 24, 2020. And little did we know. Oh my goodness. And then Jack joined the crazy train shortly thereafter. And we have a special guest, Derek Painter with US Bank. So if you were watching any of our preliminary posts about this, you knew that we had a mystery guest. We're going to be talking about Derek's perspective. I've also talked with some smaller banks and their presidents. So we'll talk a little bit more about that. But I do know that we have a question, and I told Jeff Wolfberg this week, we are going to deal with that because, it was actually, I thought it was PPP, it's ERC. Yes. Joe, Jack must have been an investor in First Republic. I don't know. He was smiling. So I have a feeling he's going to, be scooping it up for pennies on the dollar. I don't know. But here is an ERC question. So yes, ERC is still out there, and there are still people out there, spamming people and saying everything is good. But here is the question for Jeff Wolfberg. If you are an LLC taxed as an S Corp and you receive ERC checks for 2020 and 2021, in 2022 and 2023, do you need to amend your 2022 or 2020 and 2021 S Corp income tax return and your personal income tax returns because it impacts your K1? It doesn't appear to be necessary to me. After all, you're taxed on a cash basis. We understand you may file an amended 941S as part of the ERC process. Please help, as at least one accountant says it's required and others say no. Hope you guys can clarify this. Did you get all that out?
Yeah, I did. So unfortunately, I don't make the rules. And I also agree that the rule is unnecessary and stupid. But the answer is, yeah, you got to go back and amend the year that was associated with the payroll that you're getting the credit for. So if you got ERC related to 2020 payroll, what you're basically doing is you're removing the payroll as a deduction from that year, and then the same thing applies in 2021, even if you receive the cash in a subsequent year. So it's dumb, but it's not when you receive it. It's when you incurred the expense associated with the credit itself, which, frankly, another part of the reason that it's dumb is like, well, what happens when you have people that have come in and out of the partnership, or ownership percentages have changed, or, God forbid, you bought the company or sold the company. It's like, so it is a dumb rule, but unfortunately it is the rule. Now, if you didn't follow it, what would happen, if you got audited, the IRS would say, well, you picked the wrong year, to report it in, and tax rates are the same. If you got a nice auditor, they would probably let it pass, even though it's wrong. If you got a dick, frankly, sorry, Gary, that doesn't count as a swear word, does it?
Man, yeah,
yeah. If I could say it on national television, that's going to be my new rule. Then I'm going to be able to say it here. Not HBO though. Then they're going to make you amend the returns. Pay some money and some interest, but then you're going to get a refund back and get some interest back on the money. For a net maybe a couple $100 change. So the correct answer, Jeff, is that you're supposed to amend the year in which the credit is associated with, not when you actually did the credit and received the money. And so in other words, because it's falling under the tax code and behaving the same way as the other tax credits, like the research and development credit and the FICA tip credit, that makes sense. Like they're following the same logic behind that. In which cases you're omitting the returns that that were impacted to get money back. So they're just following the same set of rules here, even though they're dumb.
Yeah, Jeff coaches he has a number of roundtables that are peer-to-peer CEO roundtables. He's a great coach in town. And evidently one of his guys in his cohort was dealing with that, guy or gal, I don't know, but nonetheless, so hopefully that helps, Jeff. We sure appreciate you and what you do out there. Adam, well, so yeah, the Fed hiked the interest rates by another 0.25, and that's going to be interesting. Inflation is going on. Yes, we are talking about the banking crisis and what's going on. You know, I was listening to Kudlow yesterday, and he had Steve Forbes on, and it was really interesting hearing those guys and their perspectives as well. You know, they don't think that this thing is over yet, but we want to get Derek's opinion. There's a lot of fear out there, and there's also a lot of misinformation, I think, too, because like I said, we've talked to a number of other small banks, and we'll have some of their perspectives too. But Adam, anything else? You know, thanks for diving into that question for Jeff. Anything else that you want to hit before we throw it to Mr. First Republic Bank?
Yeah, I mean, the only it is a rant, Gary. So just bear with me, but it, you know, keeping in mind again that I have to remind everybody I'm a libertarian. So I am not for regulation. And at the same time, part of the creed is, yeah, but you probably ought to not screw somebody else in the course of living your life. So my point in saying that is that, you know, for all the pundits that are like, oh, well, you know, this is this administration's fault, or if they hadn't, you know, repealed part of Dodd-Frank, or if they had, you know, remembering that Barney Frank was on the frickin' board of Signature Bank, okay? And even he says it's not related to the removal of the component of the testing associated with small to mid-sized banks. So, you know, my only point in saying that is that, I don't know, you know, the cynic in me, it's like, the number of businesses that have self-regulated ever, you know, to do good is, I think, probably zero. So it just, you know, I would expect deeper enforcement of regulations that are currently in place, because it seems like all indications now are that, oh, we kind of knew this was a problem. We just, you know, kind of didn't do anything about it. So it just, and for the people, no regulation. It's like, it's times like this that regulation actually, and maybe she is, Joe. Maybe Janet Yellen is a leprechaun. I don't know, but you know, it is time. You know, it is times like this that regulation, you know, exists. You know, and it so it's just a hard, you know, it's just a hard balancing act, you know, between like how much is too much, how much is not enough. You know, you got the regulation, how do you actually interpret it, enforce it, you know, and then something like this happens, which appears to be a breakdown of the regulatory regime and how risk management was allowed to, you know, occur at a pretty decent sized set of financial institutions. So my soapbox is, you know, for all the people that are anti-regulation, just remember this moment if you had money in SVB, you know, and the panic that you felt at the last minute, you know, because we had clients who were actually at SVP that had, you know, millions of dollars sitting in that bank. You know, and I've continued to hear anecdotal stories of like, well, I didn't have money there, but, you know, a person I was doing business with did, you know, and it just created a nightmare. So I just, you know, this is why it exists. So rant done. Sorry, Gary.
No, it's all right. Well, Jack is, you know, sitting in First Republic Bank. There's nobody there. They're all standing outside at the ATM line, evidently. And all the other people working in the bank are cowering underneath the desks, from what I can tell there. So, Jack, hopefully you are actually one of the good guys and you don't have a gun in there or something, but you're not wearing a mask. So I'm not too worried. So you got some rants, I'm sure, too.
Well, yeah, so I had to bribe my way into here. So yes, there are a lot of people on the other side of this camera that are with their faces in the windows like this. And so I borrowed some money from the VGW slush fund to bribe my way into the back door so I could have this conversation. And there's no one here, really. I mean, they just, they shut things down and said there's no trespassing sign outside. So all good with that. But I will not rant and rave too much since we have an expert on the line and can go into much deeper detail. But I will say that one of the things I do want to say is beware of people offering to help. And it continues on. And this is just a new thing now to add on to the scams that are going on, which is, okay, we understand you, Jack consumer, are having stress and concerns about this. So we're here to help you, but you got to give us access to your bank accounts first to make sure that, you're FDIC insured and all this other stuff. And so I've seen that. And again, I have reached out to my parents and my in-laws just to make sure, they don't fall into that trap. But and then the other day received an email from someone saying, hey, I see that you're in business in a professional services firm. Have you heard of ERTC? And I was like, okay. And I laughed. It may be legit, but maybe not. But I mean,
Probably
it's just
not.
probably not. And so just beware of the other people that will help you. But I go back to what I said last week and in prior weeks, which is don't panic, don't run and melt your ATM card and pulling out your max amount per money of money per day kind of thing, anything like that. What was interesting, someone asked me, okay, so my understanding is that the bigger banks are bailing out the smaller banks, but that's not working. And so interest rates are going to go up and then all hell's going to break loose. And I have my money at one of the bigger banks. Is that a problem? And again, I said, no. Hopefully I'm correct in saying no. It's, don't panic because of just, and I don't know, Derek, if you want to go into and the differences between maybe a larger institution that may be more secure, at least the optics or appearance of it being more secure versus some of these smaller banks that might end up having some issues, whether it's because interest rates are rising, so the cost of borrowing is more expensive, so they're having maybe less borrowers, or they're being more conservative with with lending, whatever it may be. But I think that an interesting intersection between people's behavior, the psychology of it, with rising interest rates, and then having all of this commotion with these banks going on and hearing, bank failure. So anyway, those are my 2 cents for the day.
Hey, Derek, before you address that question, we had 2 questions that came in from other loyal attendees, and that's why Derek's on here, quite frankly, because he's always on here. And it was hard because we have so many commercial banker relationships and friendships out there, and there are so many good ones, but Derek is the one that has been on here consistently. Same way with Robert Mayetta, same way with Joe Farrell. So here are the questions from Robert. Does Congress have to approve 100% insurance coverage of FDIC beyond the 250K limit, or can the Fed and Treasury make that call as they wish? And then before you answer that, Joe Farrell kind of says, hey, he's on the same line here. Derek's opinion I'd like to have regarding FDIC 250K limit and the decision to bypass that and grant protection for all deposits. So you ready for that, Derek?
Yeah, sure. Absolutely. Appreciate it. And really appreciate the invitation to be here. So I'll take the bullets and we'll see where it goes. But with regard to the $250,000 limit, clearly, in 2008, it was, determined to be, outdated at that point. And yet somehow we still went back to that figure after things settled down again. But, I would argue that there are so many, companies that bypass this. And as I look at audits, so often there's a footnote in there about that. And it's just one of those things that very few people really pay attention to. But when something like this happens, especially at an institution like Silicon Valley Bank, which was, geographically not diverse and industry not diverse, there's a lot of concentration built into that institution that contributed to what happened. But 85% of the deposits for Silicon Valley Bank were not insured. And, there are some people involved in that and some people with money there who have friends in politics. And, the FDIC program is funded by member banks. So your normal run-of-the-mill banks are the ones paying into FDIC, and it's meant to be a backup. But yeah, it's up to the government to make the call on anything above that is sort of a discretionary thing. And that's where we get, then you start wondering, kind of like back in 2008, why, Bear Stearns isn't with us anymore, but Goldman is. There are decisions that are being made, and we're not always going to be privy to, what's behind those decisions. But we as an industry are looking at what's going on and saying, okay, the industry as a whole is in a great place. I will say there are some institutions that have traditionally managed a very good balance sheet, have geographic diversity, have industry and customer type diversity. You want to have multiple streams of revenue, and that's true of any company. If you have one client, it's a much more dangerous situation than if you have 2,000 clients. You lose one and it's not a big deal. Well, what we lost was the venture capital money. When there's a run on the bank, Adam and I were commiserating earlier about this, but in It's a Wonderful Life, I mean, that really tells the story. I mean, that was many, many years ago, but the truth of it still exists, that this isn't our money that we're lending. It's other people's money. It's depositors, it's investors. We do borrow ourselves in some instances, and it all kind of goes into one fund that we lend money out of. But if there's ever a run on any bank can go under, because we are by our nature levered. We're only an intermediary of the money.
Yeah. So the question is so can they? It sounds like the Fed and the Treasury, or Congress doesn't have to be involved in this $250,000 limit being raised, and hey, it's covered for all. Is that correct, Derek?
Yeah, I mean that's a fiscal policy thing, and I don't know the full legalities of all that or the politics of it, but the Treasury Department does have the ability to make monetary policy decisions, and it appears that in this case that's what they've done. So right, wrong, or indifferent, people are being made whole. And sadly, it's the very same people who contributed to what happened.
Okay, so Joe is glomming onto this one. He says Biden took credit for that decision. Can he actually make it?
Again, I would hate to say that I'm a constitutional expert. If Biden wants to take credit, I mean, the president gets a lot of credit and a lot of blame for all kinds of things that a president really doesn't have a lot of ability to influence. So, at the end of the day, Biden couldn't do that on an island. There's got to be a lot of different parties involved in actually making that happen. But, could he sign an executive order? I guess so, but I'm not here to be a constitutional expert. I wish I had that answer, but I don't know.
I don't have that answer either. I'm not a constitutional expert, but I guess I'm a little bit closer to that mark than everyone else on the line. So I'll say that, the Constitution basically says that Congress is the trustee of the country's money, essentially, right? And so while there is a lot of leeway built into and an interpretation of the Constitution that gives the executive branch a lot of power to do certain things, which is how you end up with regulations and enforcement of. Okay, so let's take a step back for about 30 seconds. The way laws work in this country is that on the federal basis is that you have statutes, federal statutes that are passed. So those are the laws that Congress passes. And it has to be constitutional, and it has to be within their powers and everything else that is fundamentally based in the Constitution, but also the interpretation of the Constitution since coming into existence over the course of several hundred years, right? And then what you have is federal regulations, which are the rules that are put forth by agencies and others at the behest of Congress, essentially, or the executive branch, or in some cases the judicial branch, in interpreting those things. And so and then you have the ability for the chief executive officer, otherwise known as the president, to issue these executive orders. And so many times, as you've seen, regardless of whether it's a Democrat or Republican, they've overstepped. And then in some cases, in the overstepping, Congress comes back and ratifies the overstep, or they abolish it and reverse it. And so in this instance, to Derek's point, is that the president can do certain things, can put things in motion and can be implemented. But then you have things like you see a federal court, district court judge in some state saying you cannot do that, and stays the execution of that particular executive order or whatever it is, alleging that it was outside the bounds of what they were able to do. And it's a power that's reserved for Congress. So when you hear about all these things, that's really what's going on in the background. I mean, there's a lot more to it, but that's essentially fundamentally what's going on. And so while, the president can do certain things, like, for example, paying off student loans, that got stopped pretty quickly. And it's because he can't just do that. He tried to, but he can't. So those are the kind of things that you see with the oversteps, and whether they're ratified or reversed down the course of time. And this is one of those situations as well, whether he can actually do what he is proposing to do, whether or not he takes the credit or whatever it may be.
Yeah, and I was going to say, I mean, soapbox Adam is just as mad as everybody else in terms of, well, seriously, these guys all pay bonuses themselves, had stock options, sold the stock before, getting shut down, all across, made phone calls to people to, move their money out because they knew it was going down. It's all a crock of shit. That's soapbox Adam. How dare there even be a hint that my good earned taxpayer dollars go to help somebody like that? And frankly, I also am equally as pissed off that nobody went to jail for the 2008 financial crisis, because, there was in my humble, non-legal opinion, there was criminal freaking behavior, that happened, but then again, but then the other side of that is I think about the practicality of is that at BGW CPA, our payroll is bigger than $250,000. So at least 2 times a month, I have to have more than $250,000 sitting in a checking account. And frankly, a good slug of that would be considered uninsured, given our payroll number. So I don't have a choice. That's just a fact of what I have to do. And, we bank with a small bank. If at some point, something like this didn't happen for SBP, you just think about the what if consequence of like, okay, well then all of a sudden our bank, has a run on it right when my payrolls due. Well, that would suck ass. So it is hard, and then you think about the other side of that. It's like, love Derek, appreciate that you're on the call. And at the same time, I hope that at some point you will say that there is a role for small regional, community banks that are out there. It's like, really, we don't want to have any of those anymore. It's like, it's just such a hard issue.
When I started in the industry, people were talking about how everything is going to combine and we're going to wind up with 6 banks or some, whatever number they picked out. And so since the early 90s, that's been the commentary. And what keeps happening is smaller banks keep opening up. So while, the consolidation will continue, we all know there is a need for that. It's just, part of the ecosystem and what makes it work. So I'm absolutely, in fact, I've worked for a couple of smaller institutions in my career. They've got an important piece to play in the overall puzzle. But going back to the presidential comment earlier, I did have one thing I wanted to add to that conversation is that my gut does tell me that it's Biden taking credit for something that he can't necessarily make happen one way or another. But I do know that he is having to ask Congress to go consider the clawback from some of the executives. Congress is going to have to make that happen. And then the discussion about, putting the regulations back on some of the smaller institutions. That is also something that Congress has to approve. That is not something that Biden can do unilaterally.
Yeah. Hey, Derek, it's one of the things we're talking about before the call, if you could kind of chime in on, is that, on the one hand, this was a failure of just enforcing the regulations. It looks like they're already on the books. But on the other hand, on the insurance side, as a business owner, I've always had the ability to actually have my large account deposits insured through some bank products that I could have purchased, but nobody does it.
Right.
So can you kind of talk about what products actually are available for people, that are concerned, that have always been available, and maybe why people don't use them?
Absolutely. I do remember when this became a bigger deal. And as I alluded to earlier, earlier on, it wasn't even mentioned in audits. And at some point, I'm not sure what year that was, but, it started showing up in every footnote, or that footnote showed up in every audit pretty much, because almost every company is going to, hit that number of any size. So if you're getting an audit, you probably have more than that in cash. So the reality is almost every audit has that footnote. And somebody had the brilliant idea to say, the coverage, and I think I put this in a message in the last webinar, but the coverage is by depositor, by institution. So you may have 4 accounts, and you're insured a combination of 250,000 of those 4 accounts, not 250,000 for each account. However, if you have an account with bank A and B and C, then you have $250,000 worth of coverage at each institution. So you have a total of 750,000. The problem is administering that is a headache. If you're having to open accounts at a bunch of banks and keep up with it and make the transfers to cover the payroll, I can't imagine the headache of that. So somebody came up with an idea of the CDARS program, is what it's called. And basically, it's a CD program that will do that diversification on the back end. So you buy this product, you put 750,000 in. On the back end, they'll put probably around 175,000 into a number of different institutions. They won't take it up to the 50. They'll keep some cushion in there, but they'll on the backside of it take care of that diversification to make sure that whole amount is insured. The problem with that is that the cost to administrate that is passed along in the form of a substantially lower return on that CD. So you're still having the I'll call it the pain, but you're locking up that money for a period of time, but you're not getting a substantial return. 18 months ago, that might have been a couple of basis points if you were lucky. To have CDARS. It basically was a zero return situation, but what you got was the insurance. The problem is that most business owners, if they're going to go to the trouble of doing that, want to have a better return than what they're looking at. And there's also been the perception that there's not that much risk in the system, so there's really no point in doing this for practically no return.
Hey, Derek, also, before we hit the record button and went live, you were talking about a situation that I think anybody that has commercial real estate on either side, they're being impacted because of the inflation, so another 25 basis points just got ratcheted up again. Talk about that scenario and what, without using names, obviously, but
Yeah.
What the scenario is, and then what could somebody be doing now if they're in that situation?
So the specific instance we were talking about is where a client of mine, a former client of mine, hoping to be a new client here at US Bank, had done an SBA loan several years ago for a warehouse that they had. And the SBA will throw all kinds of stuff into these loans when they do them, where traditional banks will do more matching, here's real estate loan, keep everything, buttoned up nicely. They'll kind of just throw everything in and roll from there. So he has this SBA note, kind of rocking along. The company grows and grows and grows, decides, you know what, we're too big for this warehouse. We need to move to another facility. So then he started leasing the warehouse to a third party. So now it's investment real estate as opposed to owner occupied real estate. The issue, though, is that many of the SBA notes are not fixed rate loans, they're floating rate loans. So over the course of the last 14 months, we've seen the rise in the prime rate and the Fed fund rate more specifically. And as a result, he's now looking at a rate of over 10% for this SBA note, and that's creating pain for him, and he wants to refinance it. Well, he's kind of missed the boat in a lot of ways, because even a traditional fixed rate now is going to be up substantially over where it was, and unfortunately, property values and rents have been based off of a very different environment. So if we were to do this deal and the cap rate was, let's say, 6% before, that would have, let's just using made up numbers, we'll say it was a $1 million property with $60,000 in net income on the property, cap rate of 6%, you wind up with $1 million valuation, right? So if you bump that now to an 8% cap rate, which would be kind of fair given the amount of increase we've had in the interest rates, then the value of that property should have gone down, all other things equal. So something has to give in this equation to get it back into balance, because either the rent's got to go up to make up for that, interest rates have got to go back down, or he's just going to have to accept the fact that the building isn't worth what it was before. But regardless in the situation, I'm having to tell him, hey, we have to haircut this loan from where you are today. So let's say the loan was 800,000. We might be able to do 650,000 on that loan now to make sure it cash flows properly given the current interest rate environment.
Yeah, thanks for that.
By the way, that's not a fun conversation to have as a banker. So it's just the reality of it. My communication with them is all math. I wish there was something I could do about it, but this is just hard numbers.
Another question came in for Papa Joe. Can Derek speak to the protection of various other investment products like money market investment accounts? My understanding is that that these are not limited to the 250,000 FDI insurance protection. Is that correct?
That's right. So most investments are not insured by the FDIC program. However, CDs, money markets that are done with a traditional bank, the disclosure should be there. You should know or be able to call your banker and confirm, but it is certainly possible to have a money market account that is insured up to 250, but there are plenty of money market accounts that exist out there, usually with an investment company, that are not FDIC insured. They do get better returns, but you're giving up that insurance as a result.
So here's another question for you, Derek. There's I think it was U.S. News and World Report thing that came out, and there are probably a number of studies that had hit recently, but this came out yesterday, and it basically said only 10% of the U.S. population has faith in the financial institutions, which is not good. So, what would your advice be to folks, in the middle of all this uncertainty and, heightened distrust, if you will?
Years ago, I had a T-shirt that said "Don't panic," and I think that's the first answer. Don't panic. That's going to lead to problems. I was around in 2008 and watched people moving money across the street, in some case physically bringing money across the street when things started to turn for Wachovia. It was a painful thing to watch, and I'm sure the same thing was happening because we had a sort of an all points thing internally because the amount of new accounts that were opening for U.S. Bank, which does have a presence in California, it was, we could see the money moving, and this has been a very different situation again because of the specific nature of Silicon Valley Bank, who they were, what their makeup was. They had a lot of cash, a ton of cash, and they didn't have a lot of loans. And so they had to buy treasuries to get some sort of return on that, those idle balances that they weren't lending out. And that also contributed to what wound up happening. I mean, we're still waiting on the autopsy to know for certain, but we've seen some numbers like a $1.8 billion loss on liquidating those treasuries. That has a huge impact on the capital base of a bank that size. And the other thing was we for the first time have seen social media contributing to a bank run. That's really never been a thing. Even in 2008, that wasn't really a thing. But in this instance, we started to see, that concern going out and being shared quickly amongst people. So, the news went out quick, and a bank that literally was solvent on Wednesday was in receivership on Friday.
Yeah. So I'd love to have you comment on some of this. So I did have some conversations with UCB folks and also with Town Bank with Ted Wolf, who's the president here, and just got his take on it because I wanted to have kind of multiple views. And he said, a lot of the same things that you said on SVB in particular. Customer base was heavy, startup and tech, foreign, that 85% were above the FDIC limit. And he also talked about the fact that they had out of control deposit growth, and that's what put that money to work in these bonds. Then all of a sudden inflation goes up and we got problems. Mismanagement of balance sheet is something that he said, but he said, the things that his advice to be looking for and asking with your current bank, and this is where I'd like to have you weigh in, is he said, look at especially Main Street banks, what's the diversification versus concentration risk? I mean, we've talked about this on the M&A side, right? If you are selling your company, if you have a whole bunch of concentration, you have concentration risk and the value goes down. Same thing in the banking world. You want to have a diversified customer base so that if one sector of the economy gets hit, you're kind of hedged in other areas. But he also talked about a thing with Signature. He said heavily specialized in crypto, so there's some concentration risk there. First Republic, he said huge depositors again, massive depositors. So if somebody moves one, if you've got hundreds of millions of dollars in a bank or whatever, that you got an issue. And I think he even referenced, somebody that had, a billion plus or something like that in it. But he mentioned this notion, and I'd like to have you go a little bit deeper if you're willing. Tangible common equity adjusted for unrealized gains and losses. Is that a familiar term to you?
Yes. So within the banking world, I guess to make it a little simpler, there are quite a few ways that we will assess our own risk, and certainly we have, we've heard about the mysterious, tests that banks go through on a regular basis as part of the new regulatory environment. So, we're getting looked at a good bit, and but I think that that starts to get into the tinfoil hat part of the discussion. I think the important part to focus on is be careful about those concentrations. I can't say that enough. And I'll add to that, in the case of Silicon Valley Bank, that you also had a venture capital company, for example, might have 20 portfolio companies. Well, the venture capital company says, hey, we're not comfortable, we're pulling out. And all 20 companies, by the way, you have to pull out too. So that decision could be made by one person or one group of people, but have a much bigger impact of all the pieces that are under that umbrella. So, even, the concentration is even greater when you put it through that lens. So, but banks have got to be super careful, and I kind of said the same thing. There was way too many deposits at that bank and not enough lending, and diversification of revenue streams is huge. I mean, it's just as you said, every business owner can relate to that. It's when you have too much dependent on one piece, that the proverbial all your eggs in one basket, you're carrying around a lot of risk at that point. So it would be hard for someone to, for most people to pull out an annual report for their bank and start doing some bar napkin analysis of how does my bank compare to other banks. We do have the benefits of which you might trust the rating agencies. Hopefully they do a better job now than they did in 2008. But there are some ways to try to assess and make sure that banks are a good risk. But a lot of times it just comes down to your intuition and understanding your bank. Is it the kind of institution that's just going to do commercial real estate, or just venture capital companies? Anytime there's a large concentration, then that's going to add risk to the situation if that industry happens to take a hit. In 2008, it was real estate. In this case, it's the venture capital stuff. The good news is that the venture capital stuff can only go so far. So when you think about the banks that that could be affected by that ripple is not going to go too far. And we as banks have already begun helping each other out. We've got a couple of banks, and U.S. Bank, one of them. We've put $1 billion in deposits in another bank to make sure that their depositors feel good about what's going on there. I take no pleasure in seeing a bank go down, because I do think that it affects the entire industry and puts a black eye on all of us. I'm not going to sit here and say this bank and this bank are super great people, or we're going to benefit from this. I take no pleasure in that whatsoever. I feel for the other people, but at the same time, I know that there was a lot of bad decisions made along the way, and I'm sure they had gotten plenty of advice that this was a systemic risk, and chose to ignore that. So I feel like there should be a consequence of that. My personal feeling is, I'm supportive of the clawback concept. That's me, Derek Panther, speaking. That's not U.S. Bank. I don't want to have that misconstrued. That's my opinion. But it bothers me that like Adam, so many people in 2008 made a lot of money and walked away, but they contributed to a lot of pain for a lot of other people.
Yeah, I agree. One other thing that I'll add to this from Ted, he said, hey, his general advice was look at the track record of the bank, look at the portfolio mix. So, make sure there's not huge concentration risk. And then one other thing that he brought up was the number of bonds held to maturity. I want to get to Bruce Anderson's question. He's got some really good ones here, but how can you find out what a bank's track record is on holding bonds to maturity? And is that a good thing or is that a bad thing?
Well, when you're holding to maturity, there, like anything, the answer is it depends. So, the environment, the rate environment, are you selling? Silicon Valley Bank got stuck in a situation where rates have moved up precipitously, and we know what has to happen to bonds if rates go up, the value goes down. So, they're trying to get more cash. They sell some of these investments, realize a loss that takes a hit on equity. They go back out and say, hey, we're going to raise equity to replace this, and the market goes, no, you're not. We're concerned about what's going on with you. We're pulling our cash out, and in 2 days' time, they're no longer with us. So you want to understand that investment policy. If they are heavy into those investments, just like Silicon Valley Bank was, then again, that gets into, a lot of risk in one place. A bank shouldn't make money by investing. A bank should make money by lending or providing services, bottom line. So if there is too much reliance on that investment income, then, they're not adding any value. And to me, that was probably the biggest lesson learned in 2008. We saw so many people say, oh, I bought this, this speculative real estate, and I'm going to flip it for 180% in 3 months. And then the question is, well, why is it worth 180% of what it was? Well, I got in, on the early end of this. Well, what value did you actually provide? And that's where the whole thing breaks apart. There wasn't any value added. And ultimately, if we as banks aren't adding a value by assessing, loans and making proper decisions and putting that money to work, then, if you're going to depend on investments, then you're not really doing a lot to add value. And then you have to ask the question, why do you exist at all? Because you're not doing what we would expect a bank to do.
So Derek, I have a comment and a question. The comment is that thank you for proving that the term "it depends" is not reserved solely for lawyers.
Oh, I was thinking the same thing.
I know you were. I saw the smile on your face when he said that. So my question to you is, all of us work hard. I make money. It magically goes from my law firm's bank account into my bank account. I can make sure it's there on my phone. It tells me that it's there, but I see my bank, I give my money to you, Derek, to your bank, and then you're basically giving it to another bank to use. So maybe my dollar isn't in my bank account really. So why is it okay for a bank? And this is, I'm being a little bit facetious and I kind of sort of know the answer, but I'd like to know fully the answer as to why is it okay for you to take, meaning that a bank to take my money and let some other bank cover themselves, basically lending my money to someone else. I mean, maybe that's the answer, which is fundamentally you're doing what the bank is supposed to be doing. It's just you're lending it to an institution rather than, into individuals or companies. So what's the theory behind that is going to make me feel okay that my money is maybe not really in that bank account?
Yeah. Well, what I would say is that the situation is no different now than it has been all along. So, going back to It's a Wonderful Life, that you may make a deposit, but that money is being lent to Sally for her house and Billy for his car. And, so there's an element of that that's out there, but banks are always moving money back and forth, which actually kind of gets into, I don't want to go too far down this rabbit trail, but when you think about what happened with LIBOR and some of the things that happened there, that was all about, money that banks were lending to other banks. And unfortunately, maybe was manipulated to a certain extent, but the problem was that the market had become illiquid, and banks, were afraid to have that money go off of their balance sheet and go to another bank. It's, I want to reserve this to myself for myself right now. So you created an artificial environment as a result. But in the natural way of things, there should be times when one bank has excess capital and another bank has something going on and maybe has a little bit of a need, and money should be able to freely move through the system, to put it in the right amount of money in the right place. So, I would say that what has happened, and again, this is Derek's opinion, I think that it probably was a lot more money than needed to be moved over. I mean, $10 billion is a lot of money for that size of an institution. But I think a message was being sent to say, you know what, we're gonna hunker down. We're gonna take care of our own. We want to prove to everyone that the system has strength, and then that we're willing to back up a bank to make sure that this does not continue. So, are there probably some banks out there that may have some issues that we don't know about? I would be surprised if there weren't, to be honest. I mean, I don't know of any. I'm not privy to any of that knowledge, so I don't want to suggest that or have anybody go try to make trading decisions based off of that. That is not investment advice. That's just kind of intuitive. There may be some folks out there, but but what we want to do is send the message as banks that we can put a stop to it. There is enough strength in the overall system that we're not going to see things spiral out from here.
So we got some good questions that have come in. I want to deal with Bruce's first, just because he's been sitting there for a little bit. He said, so here's the question. Is it the job of the chief risk management executive to monitor and prevent over industry or geographic concentration in financial institutions? So that's first question. Second question is, how much internal conflict is there between risk management and those responsible for asset and revenue growth, like you? Or the third one, like SVB, do they just wait until an auditor challenges the asset portfolio?
That's a lot. So I will say,
you want me to hit the first one first?
No, that's okay. I'll try to kind of lump them together and see if we can come up with a coherent response. I once was having a cocktail debate with a doctor about which industry was more regulated, banking or medicine, and I spent some time actually researching that, and what I came up with was that neither was the answer. The most regulated is nuclear power. And I'm kind of glad that was the correct answer, because I wanted, by all means, put as much regulation as you need to on that, because none of us want to see anything go wrong there, right? So, but then that leads over into other energy sector type companies, and you think about the environmental implications there. So good with that. And then you also had the car industry. So the amount of regulations for them actually exceed. So then banks come up next. So I did actually, on a relative basis, I won that debate. But the fact was that neither one of us was at the top of that list. But the point of that is to say that we are extremely regulated, and that the balance of power belongs there. So the chief risk officers, that is a part of what they do, but that is a very difficult job. But I will say that internally, a CEO of a bank has to make decisions. But at this point, in my experience, most of those decisions are going to lean on the side of regulation and lower risk versus pushing for more revenues. And I know that may be hard to believe, but that is my reality. My day-to-day work is so different now than it was when I started in this, and certainly even since 2008 has changed tremendously. Something as simple as ordering an appraisal is now a labor of love, as opposed to me going, okay, you got what kind of property here? Okay, yeah, these three guys are solid. They're probably the ones that we should have bid on this. I can have no influence whatsoever on the appraisal process. It's a double blind situation, and you make the decision on, if you get some bids, one of them is going to be the lowest bid and one's going to be the fastest bid. And if they both happen to be the same bid, then that is the bid that wins by default. But you can make a choice if you have, two to choose from. But it has to be a decision made on that basis only. So I don't get to see even who was invited to bid. I've got no way of knowing. It just has to be somebody on our approved list. So that's a very small example, but our world has changed a lot, and so the balance of power certainly goes towards those folks that are in credit risk and in that overall risk world within the corporations.
Well, and the fact is, they SVB went for months. What was it, 6 to 9 months without a chief risk officer? Not good.
Yeah.
Hindsight's always 2020, but like, man.
Right. Well, and again, that's one situation. I would say that most CEOs of banks, that would be problematic. I would like to think that that's the case. Again, there's a lot to be determined. There's a lot to this autopsy that has not yet really happened yet, but could that be a contributing factor? I don't see how it could not be a part of it. But if I were the CEO of a bank, that is definitely a position that I personally wouldn't let sit dormant that long.
So I want to get to Tom's question before we close out at the top of the hour, and this had to do with kind of those money exchanges going back and forth with banks. But so Tom says, doesn't crypto fall into the same thing? It seems like those that have done well have done so at the expense of others in crypto, not growing a business, not providing a product or service. An interesting thought. I
agree wholeheartedly. I go back to what I said earlier. From my experience, if you're not creating value, you're not creating value. So if things are artificially growing in value, then that's an artificial environment, and I have a hard time understanding the crypto market. I personally have not gone there. I know people who have. I know one client, I had to kind of recuse myself from the situation, but they got hit by ransomware, and the currency to get them out of that was Bitcoin. And it's there's just so much about it. I'm a banker and probably more conservative than most people by nature, but that is something I just haven't been able to get around personally. I can't piece together in my mind where the value is created.
This has been a great discussion today, guys. This has been really good. And Jack, I don't know what it is. You must have a huge travel budget because you go to all these amazing places. You're, one day you're at the Capitol, next you're up in New York at First Republic. It's amazing.
I get bored easily, so that's what it is.
Hey, while you're in New York, you might want to go see the Kansas State Wildcats. Hopefully they take down the Michigan State boys tonight at 6:30 Eastern. We don't get to cheer all that often for Kansas State basketball, so I'm going to just milk it for all it's worth.
No, that's good. We may end up having a watch party. I think my in-laws side of the family are K-State grads, and so that's probably what we'll be doing tonight.
All right, that sounds good. Derek, thank you so much for joining us, man. This just added a lot of insight, good perspective from somebody on the inside. It's also good to know that you know some lawyerese of it depends. Not everybody can use that one.
Yeah, I think it works really in most walks of life. We don't have as much black and white as we think we do sometimes.
That is true. And even Adam Boatsman has used that line a time or two. So,
Rarely, but yes.
yeah, rarely.
Thank
Well,
you so much for having me. It was a real pleasure. And, if anyone wants to reach out, I'm sure, Gary, you can point in my direction, but I'm glad to
Yeah,
have any
sure.
sort of follow-up questions with anyone with questions.
Yeah, no, thank you
look-
very much, Derek, for being on.
Yeah, we really appreciate
pleasure.
it. Look up Derek on LinkedIn, Derek Painter at US Bank, if you want to connect with him. Also, anybody that came on late, we had a good crew today. We'll put this thing up on BGW CPA YouTube channel later on this afternoon. So thank you again. Enjoy the sunshine. It's back out. So, and go K-State. All right, take care, y'all. See you
Thank
next week.
you.
Lord
Yeah,
willing.
thank you.
Bye-bye.
Well.